Good afternoon, everybody. Luis here, wishing you a happy new week as always. And this is your weekly market update to give you some insight on where the housing market is at right now and where we think it's going. Again, if there's anything that you want me to research and confirm, simply reply to the email or comment below. This is going to be a short one because there's not much news this week. So let's jump right into it and jump right into notable news. And for that, let me pull the last week's dog and pony image because I think that's funny. And the debt ceiling dog and pony show continues. Yellen keeps yelling that June 1st is coming, and she is sounding all the alarms. So that is a deadline. We need to raise that the debt ceiling. So what can happen if the ceiling is not raised? First, the stock market is going to be the first to feel the effects, and it'll cause a sudden recession and wealth across the nation will plummet. 2, federal workers will be in limbo, including the military. It's like, are we getting paid? Are we not? 3, Social Security and Medicare will miss payments. 4, U.S. borrowing costs will soar. And that's because we now have bad credit if we default on this as a nation. 5, economic problems will spread worldwide and cause a global catastrophe. 6, the dollar drops along with the U.S. prestige. All right, is that enough doom and gloom? This is why I call it a dog and pony. It's all political stuff that we don't need to get into. We've been here before. It's always a crisis and it gets resolved. So let's move on to last week's economic news because that was pretty exciting. So last week was great for inflation. The CPI inflation report came in lower, indicating a steady disinflation year over year. That's good. Also, we have oil prices that are also lower this month. So that's going to reflect on May's report, and that's going to be good. Then we had the producer price index, which is an inflation index for businesses, also came in slightly lower than expected. And then we had jobless claims, which were also up. And I know this is not good for those that lost their jobs, but I'm sharing all of this because all of this is disinflationary. And the reason I talk about it is because inflation is the worst enemy of mortgage interest rates. So when we see disinflation, that's great for mortgage rates. Now, this week is really quiet. All we have is jobless claims again on Thursday. There's some other market news, but it's not, I don't think it's going to move the bond market and affect the mortgage interest rates too much. So let's take a look at that. Bond market is also not doing very much. Things seem very peaceful. Last week, the 10-year yield was at 3.5%, and today it's at 3.49%. So not much of a change there. And let's check out today's rates. This is based on a $500,000 purchase, owner-occupied single-family residence, 740 FICO score. So on the left, we have a VA, 5.875% interest rate on a 30-year fix. So there's no change. So it's still holding steady. The FHA loan program, it's up about 0.25% to 6.125. And then conventional, finally, on the right, you have 6.5%. So we actually dropped about 0.5% on this program. Overall, rates have been steady, but remember, you're not buying a home because of the rates. You're buying a home because it's an intelligent thing to do. And as a homeowner, you reap some benefits that you don't as a renter, like tax deductions at the end of the year, paying down the principal balance on your own loan and not your landlord's loan, because you're paying a mortgage. It's just not yours. It's your landlord's when you're renting. And of course, appreciation, which is the icing on the cake. So reach out if you want to go over some of these numbers, and we can re-review a rent versus own analysis and an appreciation forecast with the updated numbers. That is all I have for this week. Follow me on Instagram at @LuisRenteria_home loans for daily homebuyer tips and day-to-day updates. I appreciate you all and have a wonderful day.